Good afternoon, everybody, to the Polaris Trading Group's PTG University Educational Series. Today is March 23rd, 2016, and we are on Module 15. Today's topic is going to be a long-awaited request workshop regarding the 3-day cycle. This will be part one of a two-part series. The 3-day cycle is also known as the Taylor trading technique. Now, this particular technique is a mainstay, and it has been a mainstay of our methodology for quite some time. It acts as a framework from which we base our trade setups and the action of the overall market in general. And you'll see it's actually a very accurate 3-day period with probabilities and projections of price ranges and highs and lows that come very close to being fulfilled on a regular basis. So before we get to the details, industry regulations do require that we at least highlight the NFA Compliance Rule 2-29. Many of you are already familiar with this, but simply that hypothetical performance results have many inherent limitations, and trading in futures and options and derivatives on futures is speculative in nature and involves substantial risk of loss. Right? Past performance is not indicative of future results. So on slide number 1 here, this particular presentation is going to be more conceptual, so please bear with me. We do have a number of charts, but most of it is to get through the concepts of the 3-day cycle, and we'll get to the charts and examples throughout the presentation. So a little bit about the background and the core premise of the 3-day cycle. It was originally created by a gentleman by the name of George Douglas Taylor. He was a trader back in the 1940s and early 50s, and he essentially traded, I believe it was primarily the grains at the time, because we did not have the financial futures as we have today. And he noticed that the prices tended to oscillate in a very rhythmic fashion every 3 days, where the price would be pushed lower, and then it would bounce back, and then it would push higher. All right, and would go through the cyclic nature, of highs and lows back and forth. Now, the inherent nature of markets are bullish, so that's one of the core premises that you need to understand. So today, for instance, if you take into consideration the mutual funds invest long only. All right, they're not short traders. You have certainly hedge funds out there that do lots of short trading, but the mutual funds primarily are long only, so they're bullish by nature. All right, they go through their periods. Markets go through the periods of bear markets, all right, corrective phases, all right, but generally, even in a bearish type cycle, all right, the markets do have and continue to exhibit a bullish tendency. All right, so the 3-day cycle is essentially a short-term method to read the inherent choppiness of the markets that are experienced. And again, a lot of times the markets can just seemingly go back and forth, oscillate without really any directional bias. Majority of the markets trend only about 30-35% of the time, and they're in balanced type of range type conditions, or some people refer to them as choppy conditions, but more actually the majority of the time. But even though when they're in that type of condition, there is generally a lean, whether it's to the upside, to the downside. So think of the markets going through a period of contraction and expansion. Contraction and expansion. All right, that's how I like to describe it to our members. And there's a rhythmic fashion to it. And so George Taylor, back in the early 40s and 50s, trading the grains, he saw that it was more of a cyclic nature of price action, And his basic view was that the markets were driven by the large institutional investor, or i.e. the smart money. He was a small guy, right? Small contracts, right? He was, trading with the big boys, and, he just understood that they really drove price action, as they do today. Right? Nothing has really changed from that core premise. So the markets today are still driven by the large institutional mutual fund, hedge fund type money manager, okay, and traders and investors. Yes, it is dominated today by high frequency trading, which is all computerized, but even to that nature, those algorithms and programs are driven by still the large institutional investor, okay? So as a core premise to understand what this 3-day cycle is all about is it's really the collective action of all that smart money, right? And again, not everybody is buying at the same time, right? Money managers are rebalancing their portfolios based on their own views of what the business and economic conditions are and market conditions are. But simply the collective action of all those decision makers in these large institutions simply drives the prices from extreme highs to extreme lows, right? And it's a repeated fashion, and we see this every day. All right, you can just chart the swing highs and swing lows, and again, as you can see, it's more cyclical in nature, and the basic core premise is the 3-day cycle. So the structure of the 3-day cycle is on cycle day 1. It's also been referred to as a buy day. Now that's a little confusing, all right, but we'll get into the understanding of what that means as a buy day. But I like to refer to them simply as cycle day 1, 2, and 3. And as long as we understand the premise of each day, then the title that you give it, all right, doesn't really matter. But cycle day 1 would be also considered to be a buy day, cycle day 2 a sell day, and cycle day 3 a sell short day. That was the original language that was used by George Taylor. Now the cycle pattern is simply generalized from a rally from the cycle day 1 low. So as I describe this, take a look at the chart to the right hand side, and I've put a graphic of this. Rally from the cycle day 1 low to the cycle day 2 high. That is once the cycle day low, or what we like to call a secure low, is in place, the market then proceeds to clear out all the remaining sellers and then rally to a point where it creates a cycle day 2 high. Now, how high that level is, we have projections that we can calculate, and those are given on a spreadsheet, the proprietary spreadsheet that we use, and that'll be a discussion of part 2, all right, of the 3-day cycle. But for now, just understand that once that cycle day 1 low is found, and it is found to be secure, then that opens the door for the rally, which pushes it up to cycle day 2 high. And then at that point, depending on if it's successfully met the projections or not, cycle day 3 could have continued strength, or, as we'll discuss a little bit later, most recent couple days here, if the market doesn't proceed to move higher, then that's the beginning of the next cycle decline. So the end of one cycle, the beginning of a new cycle, and the decline from cycle day 3 high down to the cycle day 1 low, okay, which today, by the way, is a cycle day 1 low. So that's the basic setup of the 3-day cycle. So let's get a little bit more deeper into it, and we'll discuss the concepts and assumptions of the 3-day cycle. So this is really important on understanding what's going on here. So remember, it's driven by the smart money. the big institutional players. So the type of strategies that they run, all right, on the 3-day cycle is, number one, they want to force a violation of the previous day's low, right? So if you take into consideration a high-low range, okay, every day we want to, those are key markers for all traders, and all traders should understand and what those levels are. But they want to force a violation of a prior low. Now, they may not always be successful at that, depending upon the supply-demand that's going on at the time or the momentum. But the strategy is force a violation of the prior day's low. That creates a selling panic, all right, and then buy it as low as possible. So, for instance, today is cycle day 1. The goal of cycle day 1 is to find a new secure low. So what happened today, as an example? Today, they forced a break of the prior low, the cycle day 3 low, which on a gap, which created a selling panic, in a sense. All right, and they want to continue to push that as low as they can. When I say they, I mean the smart money, the big institutions. Force it as low as they can so they can buy it as cheaply as they can. All right? So that's the idea of a buy day or cycle day 1, is to buy it as cheaply or as low as possible. On the flip side, right, as the cycle progresses upwards on cycle day 2 into cycle day 3, is to force a penetration of the previous day high. So a penetration means taking out a prior high in order to sell what they purchased the day before on cycle day 1 simply at a higher price. Makes sense, right? They're not always successful in doing that. Sometimes, it takes some backing and filling on cycle day 2 in order to get that. But the basic premise is that once they have that cycle day 1 low in place, they want to then drive prices higher so they can sell them higher. All right, this is what it's all about. And again, if you think about the collective action of hedge funds, the high frequency firms, as well as, again, the larger mutual funds, all right, the idea is to is just that. Okay, you want to buy it as cheaply as possible, right? Buy low, sell high, right? It's a little cliche there, but in essence, all right, there's a lot of fact to that. And then once they're able to get price high enough, if there is lack of any follow-through demand, and they recognize that there's no longer any real demand happening, then that typically tips out the top part of the cycle. And again, we have projections and probabilities of those levels being achieved, and if they are failed to achieve, then the cycle pretty much completes, and then the new cycle begins. And as we saw today, cycle day 1, all right, was a normal decline day of what happened today, and we're going to get into that in the next slide or two. So simply, the basic concept and assumption for the 3-day cycle is that the end of a cycle offers the greatest amount of opportunity. All right, so at the end of a cycle day low or a cycle day high on cycle 2 or cycle 3, all right, that's where the greatest amount of opportunities. In other words, the risk-reward ratios, all right, are most favorable. And the large institutional player, i.e. smart money, looks to position themselves, right? Remember, they're not day traders. They're longer term, and they're swing trading and so forth. So they work to position themselves in a way. Now again, are they always correct? Is it always perfect? Of course not. Nobody is. All right. So then the last part of the concept and assumptions is the excess extremes mark the end of one cycle and the beginning of the next. So we talk about prices being at extremes, not so much overbought and oversold, but we refer to them as extremes. And again, we have ways of identifying those extremes. Okay, so on the next slide, let's move on. We want to talk about the concepts of violation and penetration. And these are two terms that I use quite often in the trading room, and this is the vernacular that is used by professionals out there. All right, so understanding violation and penetration. Simply when the market has a tendency to exceed the previous day's high or low, all right, there's some residual momentum from the previous day into the next day. All right, so that essentially results in what's called a violation or penetration of the previous day's high or low. So for instance, a violation simply is a break of the prior day's low, or an expansion of the range to the downside. A penetration is a penetration of the prior day's high for an expansion to the upside. So understanding those two terms are important when we discuss the 3-day cycle. And again, I use these terms quite a bit now. But though sometimes the residual momentum will be very strong and carry, it can carry price far beyond the highs and the lows of the previous day. Now, when that happens, we have projections of how far prices may carry on a specific day, cycle day 1, 2, and 3. And it's based upon a large data set of historical observation. All right. And now also other times what happens is price will reach and trade very near to the prior day's high or low, find support or resistance, not expand through it, and then retreat or reverse back into the range. So we're not talking about predictions of what's going to happen with the cycle. All right, this is not a predictive type, right? But it forms structure of how the cycle. So we're always dealing as traders in probabilities. So what's the probability of prices expanding outside the prior day's range? Do we know that if price is still within the context of the range? Right? Do we know, I mean, with any real assurance that the price is going to expand higher or lower while we're still in the context of the prior day's range? No. Prices somebody has to initiate trade outside of the prior day's range to try to expand that range. All right? They may be successful. They certainly may not be successful. All right? But if they are successful, then we have ways of measuring to what degree or extent they're able to push it, all right, extend the range, and again, we have projections and probabilities based upon that. So let's just say if the market closes low in its range, so here's another part of the concept that I want everybody to understand. When I discuss the high-low, those are the parameters. So the three major points of the day, similar to a compass, is the high, low, and midpoint of a range. All right, those 3 points, just like north, south, east, and west, high, low, midpoint. Then within that, there's a upper 25% quartile, and then there's a lower 25% quartile. So that splits the entire day, if you can visually, in your mind, that it's divided up into fourths or quartiles. All right. So the idea, that's important, and the reason for that is if the market's closing low in its daily range, so the lower 25% quartile, all right, the low of that day becomes a key reference point for the next day. All right, so those highs and lows are always going to be key reference points. If the market closes high in its range, right, for the next session, that's going to be the key reference point. All right, and the closer it can close to the high and low of the range, the more important that particular level for the day is going into the next day. All right, it should be a pretty straightforward concept there, but many times it's overlooked. So I mean, this is an important part of what we're talking about, whether or not the highs and lows get violated or penetrated. So simply in general, a move that violates or penetrates the day's reference point. So what's the day's reference point? You have two of them. All right, high and low. All right, so it can either be accepted or it can be rejected. And we use those terms, and many of you that are familiar with market profile or volume profiling, you also are familiar with the concept of it being accepted or rejected. So we don't know whether it's going to be accepted or rejected. That's why we use our OTA loop, all right, decision technique to identify whether or not and make some assumptions and some by reading the market. Yeah, this level is getting accepted, or it's being rejected. So we saw today that the opening range rotation, they tried to move it up. They meaning the big boys tried to move it up above that level a few times, and each and every time got rejected. So that tells us something about the quality of the trade action that's unfolding at that price point and the ultimate intention of the market players collectively. All right. So again, just as the last note here, if price is rejected after violating and penetrating the reference point, the low or the high, you have a reversal. So a rejection is a reversal, and that becomes a trade opportunity. That's what we're looking for. Is price accepted? Will it break out? If it doesn't and it reverses, is there an opportunity? Yes, that becomes an opportunity. And that's where the smart money begins to take action, all right, for the next directional cycle move. All right. All right, so let's get into the individual cycle days, and we'll run through these, fairly robustly. All right, but what's the main task for the cycle day one? All right, so this is the first day of the cycle. It's simply to probe for a secure cycle low from which to stage the next rally. Now, over time, over these past months, this is something that I continue to drill in on a day-to-day basis in the daily trade strategy. Right? The daily trade strategy is written in a way where it brings in the concepts of the 3-day cycle. And during the session in the trading room, many times I'm always reinforcing the fact that price is being probed for a low. So in a sense, on cycle day one, the norm is that there's a decline to probe for that new low. Where that new low is ultimately going to be placed, again, rather than predicting, we have some projections of potential. But ultimately, the market is the final arbiter of where it decides, where that low is going to be. All right, so the main principle is simply that, again, we're looking for a decline from the cycle day 3 high at the end of the prior cycle, right, down to whichever final secure low is in place on the cycle day 2. All right, and there's an average decline value that is calculated based upon a long-term historical average range that has been observed from the cycle day 3 down to the cycle day 2. And again, that will be all the subject of the spreadsheet, the proprietary spreadsheet that everybody will have access to, all right, after our presentations now going forward. All right, I highlight these levels in our daily trade strategy. Again, it's a core part of what I try to convey on a day-to-day basis of how we're setting up, what we're looking for the day, what's the expectation or the inference or assumptions for the day. Okay, so throughout the course of cycle day 1, bounces within the context of the day are used as short selling. And I think we saw most of that today, since today was cycle day 1 in this current cycle. We saw the bounces today failing to carry above that opening range, and aggressive traders out there and money managers and so forth that employ the 3-day cycle. Again, not every manager out there in the world does so, but for those that do, they use the bounces as a day and as a way of selling short. Right? So selling short may be considered until that final low is in place. But once that low is reached, okay, people close out their positions. Those that feel confident that a secure low is in place, All right, now again, once a low is in place on cycle day 1, it does not necessarily mean that that is the final secure low, but it is the low on cycle day 1. As a matter of fact, today it was a textbook cycle day 1, and we hit the projected range low right to the tick of 20 handles. So today's low at 2025 spot 25 currently is the new cycle day 1 low, and whether or not that becomes the final secure low, right, we won't know until tomorrow. But the idea simply is, if the large institutional smart money type players feel confident about that that's a secure low, they're going to use this opportunity throughout today and perhaps even into cycle day 2 tomorrow to continue to buy at those levels, all right, and to clean up whatever sellers that may be around, all right. So there are many ways to enter, but again, if you're a swing trader, all right, we on the other hand are not swing traders. We are intraday traders, but we want to stay in alignment with what this cycle offers and understanding what's going on there with the larger institution, so we can position ourselves in a way to ride, the action along with them. That's what we want to try to do. So I'm always trying to stay in alignment with the larger institutional player. Okay, so here's a graphic of what I just discussed. So maybe it'd be a little easier for us to read that. So let's just follow the little bubbles here. Is on number 1, right? So again, the decline begins from cycle day 3. So at the end of the prior cycle, right, smart money decides that the buyers have dried up. There's no more interest at that particular level. Okay, it's time to sell whatever final longs that we may have, and let's establish a short position. So that's what happens on cycle day 3 once the buyers are fulfilled from the prior cycle. And then as this is occurring, this creates selling pressure throughout the course of the day. And what we saw yesterday was lack of follow-through at the highs. There was I think it turned out to be like a little mini triple high yesterday. And we had a market on close sell imbalance of close to $2 billion cash equities. So does that mean everybody is selling them on, short at that market on close? No, of course not. But the fact that prices could not move higher during the cycle day 3 trading session, all right, begins to create that selling pressure, be it long selling or new short selling, all right, for the cycle. Now today, coming into cycle day 2, so once the cycle day 2, once on bubble number 2, once the cycle day 3 low is violated, so using that term violation to force a violation, to force long liquidation. So what does that mean if on the low of cycle day 3, low is violated? Everybody that bought yesterday or the day before, they're trapped. So what the idea is now is entering on cycle day 1, as you can see the labels here, CD1, CD3, CD1, CD2, is force a low violation of CD3, forcing longs to take to liquidate. The shorts that establish themselves on cycle day 3 are in the money, and they will continue to press as they actually did today on cycle day 1, right, until they reach some average range level, right? So there's usually a projected average decline from cycle day 3 down to cycle day 1, right? And again, this helps to create a potential for a cycle low, all right? So short positions, as I said, as the lows are being made, all right, those that are short from the day prior or earlier in the current cycle day 1 session, again, they begin to cover their positions. Right? They may not cover them all, but they probably cover most of them. All right? And that kind of completes a short cycle for those that initiated shorts off of that CD3 or cycle day 3. Now the larger big money, all right, institutions which are typically long only, all right, they're really looking, they're not looking to sell short like we just described, but rather they're looking to use cycle day 1, understanding the nature of the cycles where there's an expansion and contraction. All right, so in this case, a pullback within the context of the larger picture offers them an opportunity to buy, right, on the pullback, buy on weakness. All right, remember the big institutional money managers, they're not day trading. Maybe some of them are, but majority of them, they're mutual funds. Again, they're long only, so they want to reposition their portfolios. Maybe they have a number of stocks that are on their buy lists, right? They use this as an opportunity, weakness on days like cycle day 1, to establish new positions. All right. So again, think about this as the collective action of everybody. All right, not just one individual, mutual fund or anything like that. So once this low is finally put in and the sellers are flushed out, all right, the beginning of the new cycle back to the upside begins, and that leads us into cycle day 2, which for us then would be tomorrow. So on the next graphic, we'll take a look at cycle day 2 here in action. So again, just recall, this is just a continuation of the same chart. And at bubble 1, this is where the sellers concluded and the buyers had stepped in, as we just discussed, as mutual funds and so forth. All right, and then they begin to move price back up, cleaning out whatever residual sellers that there may be left over, but any residual sellers more likely are not strong, and the rally now can continue. Now again, the rally from the cycle day 1 low, that secure low, to whatever the potential high is for the cycle day 2 high, right? Again, we have historical projections. Does not always reach those projections, but it gives us a guide of what the potential is. And then as the day unfolds, right, we look to see how the market is reacting relative to the projected potential for the day. Right, so the markets always have a level of potential on a day-to-day basis. Okay. All right. So if you think about it, so as smart money, having established long positions at or near the cycle day 1 low. Right, so now this allows the new cycle, to proceed until that projected average. We have what's called an average range high. So we spoke of an average decline. We have an average range, or what we simply talk about is cycle day 3 target. All right. So until that potential is reached, i.e., on the cycle day 2 high, right? Opposite to what we just discussed on cycle day 1, longs can be considered. So if there's a pullback in price on cycle day 2 that does not violate the cycle day 1 low, meaning that there's a secure low, right? Open longs can be considered. So buying that pullback within the context of that the cycle high or projection has not been reached yet. So the big institutions want to continue to buy that, and again, the selling that more than likely occurs on cycle day 2 is residual selling, usually not initiative, type selling. Okay, so again, the idea is to try to close the cycle day 2 as high as possible. All right, again, not always the case, but that's the goal. All right. So Steve asked, if cycle day 2 makes a lower low or a lower high, all right, does that influence how much of the cycle day might rally. It may, if again, there are times where cycle day 2 is still part of a decline, that the secure low or the low of the cycle may or may not be 100% in place. So given that the cycle day 1 creates a low, we're not sure 100% whether that cycle day 1 is the final low. It could actually occur on cycle day 2. And when that does, we actually have, there's odds of a rally back above the cycle day 1 low. And we'll discuss the idea of what constitutes a positive 3-day cycle. All right. But there could be certainly cases where that will be the case, where on cycle day 2 we still have a series of lower lows and lower highs. All right, that will influence how much of a projection that price can rally, because it may take a couple days before it finally gets to rally. All right. Probability-wise, the 3-day cycle has very good odds, up to the 84% of a positive 3-day cycle. All right, and again, we'll discuss that on an upcoming slide, what constitutes the cycle. But that's a great question, and again, there are always variations. So what I'm giving you here, everybody, is this is the template. All right, this is the ideal cycle, and at times we do get an ideal cycle. There are other times where the cycle, there are variants, all right, of the cycle. A day doesn't unfold as normal, so we would call that an aberrant day. All right, but that doesn't mean the cycle is broken. Any cycle sometimes can extend, right? Holidays can affect the cycle somewhat. All right, things like that nature. But certainly news events, right? External things going on, geopolitical happenings around the world certainly can affect the cycle. All right, but as with any cycle, if it gets disrupted, it generally will kind of, it's like a kayak. You flip a kayak, more likely, it'll right itself back up. All right, so the cycle tends to at times get bumped. All right, and it may not, be this perfect cycle that we're describing today, but it does, eventually right itself. And during those periods, there's ways of identifying it and the ways of making adjustments to it. And again, that's more about the education overall. So this particular presentation is focused primarily on, the core part of and the concepts, of the cycle itself. All right. Okay. Good question. All right. So now this leads us into the final part of the cycle, or cycle day 3. All right. And there are, 2 conditions. All right. So if price closes on cycle day 2 in the high part of the range, right, that high of the day, whatever that may be, right, becomes the key reference price. If prices then can rally or extend beyond cycle day 2's high, then we have an extension or potentially an expansion of the cycle. All right, and again, we have projected levels. All right, so what we're looking for on a day-to-day basis is we're looking for that acceptance or a rejection of those cycle of the range highs or lows for the day. All right, and if you've never thought about it this way, this is kind of a natural way of understanding, trying to look at what the market's action is doing, the auction, and then simply we're trying to, understand is it being accepted or is it being rejected? All right, if it's being accepted, what does that mean for me? Is there an opportunity? Maybe I should be paying higher prices now simply because price is being accepted. How do we know it's being accepted? All right, and again, to bring in a market profile concept is time and price. All right, volume and time and price. So for instance, the longer price stays, at a location, the greater number and the greater volume that's created in there during that time period. okay, that particular price point or level or zone is more likely to be viewed as being accepted. So even if it is at a higher price, if it's being accepted, that means there's more likely to have continued higher price action coming. Vice versa, if price is sitting on lows and it's not being reversed, okay, that level is more likely being accepted. So we're looking for that failure or rejection, all right, constantly. So in this example here, all right, it shows that on cycle day 3, the beginning of cycle day 3, could not, where it's pointing on bubble 1, prices could not penetrate cycle days too high. So what does that tell or indicate to the smart money out there? Well, if on cycle day 2 prices are at or near highs, what is the smart money more likely doing on cycle day 2, especially if they're able to push it to levels where projected ranges are? They're more likely paring back their position, selling it to those buyers that are coming into the markets late. All right, there's always going to be a late buyer or a late seller out there, right? So they're going to be selling into that potential final demand that's being created. Well, we don't know that's final demand on cycle day 2 until we start seeing what happens on the next day. Does price continue above cycle day 2 high? Does it get rejected? That will give us an idea of whether or not those latecomer buyers, in a case like this, would be trapped, like we saw today from yesterday. All right. So in this example, as you see on the slide, this is a case where buyers were not able to expand price beyond cycle day 2 high, and as a result, that indicates to the smarter money people, all right, that, you know what, I better start getting rid of the rest of my holdings, contracts, individual stocks. By the way, this particular cycle concept works for individual stocks. It works for all various instruments. All right, it's not just for grains or for the S&P 500, but it is universal concept that applies to actual individual stocks as well. So think of it from that standpoint, that it's a strategy, trading strategy that applies universally. All right. So what happens then on? All right. Well, okay. So how do you define a forced violation? Good question. We're coming right into that. So a forced violation is a push below the prior day's low. So in this case, on the slide here on the left side of the slide, it's cycle day 2, right? So price pushed up to, let's just call it a projected high target. We can see there that magenta zone is the 3-day central pivot zone, tends to be a target level for us on many days. So a forced violation is failure to move above the prior day's high, which is the cycle day 2's high. Can't get through that. Let's go sell them. All right, and they push it down to the cycle day 2's low. Now, what is anticipated at the prior day's low? Well, if the buyers held it there yesterday, the anticipation or inference would be that that low would probably elicit responsive buyers that bought them yesterday. But if the supply today, cycle day 3, is greater, and the buyers that bought them yesterday are latecomer buyers, if you will, they're more likely not going to be the strong group. And a forced violation would mean a break through the prior day's low, cycle day 2's low, and that creates anxiety on the part of the buyers that bought them the day before, and they may be forced to say, I'm selling them too. So that just creates more selling, and it's essentially a forced liquidation scenario. Okay, does that make sense? Okay, so good. We're on time here. So this is the final part of the 3-day cycle. And where, again, we'll review that in a moment of everything. But let's, on the next slide, we'll discuss some final comments about the cycle and observations. So first off, we know that the 3-day cycle begins from cycle day 3 high minus the cycle day 1 low. That's the range that is the initial starting point of the calculation. So once they have established a cycle 3 high, right, that distance from that high down to whatever the final CD1 low is, that constitutes a range. Right, so it's not the range of the cycle day 1 high or low, but the range from the cycle day 3 high down to the cycle day 1. So it's a 2-day range in a sense. Okay, so what our current statistics show over a long period of time on most instruments, there's an 84% probability of a positive 3-day cycle, even though, right, even, you know, if we have bear markets, right? So why is that? Why is that there's 84% odds of a 3-day cycle? Remember what I said earlier. The large mutual funds are long only. Yes, they do sell, but they have so much buying power that even on dips in the market, they tend to absorb that selling and push it back up because it's in their best interest to do so. All right, so we go through these periods where, you know, we got kind of this bearish action, and we got, you know, but even in the bearish action, you know, people will be calling for a bear market, but in essence, it's just a pullback. Sellers get absorbed, and then they push it back up. So what constitutes a 3-day rally? All right, now you may need to review this presentation a few times because it's not necessarily an intuitive concept, but the more you do work with it, and since I comment on it daily in the daily trade strategy, all right, it will become clearer, all right, the more you work with it. All right, this is not a one-off workshop. A workshop is just that. You know, you take your block of wood, you take your sander, you take your plane, you take your nails, you take whatever you need to, you take this block of wood, all right, and you work with it. If you take the block of wood and just put it onto the side and say, yeah, okay, yeah, we had a workshop on that particular, you know, and never work with it again, then you're going to disadvantage yourself. All right, so if on cycle day 2, price closes on the high, we should expect a test of these highs, and shorts can be considered upon failure or rejection of such a test. In other words, we just saw the slide, right? Let me just go back to this slide right here. All right, so on cycle day 2, we got to put it in a high. So if coming into cycle day 3, there's usually going to be a test of that high. If that test fails, okay, then that's what's considered a rejection. All right. Okay, so now if price closed on the low of CD2, cycle day 2, and that low is still above cycle day 1's low at the open of cycle day 3. Now again, we'll take a look at a chart here, a live chart from the past couple days, and we'll see that. But again, just walk through that a second with me, right? So if price closes on the low of cycle day 2, but that low is still above cycle day 1's low at the open of cycle day 3, right? Then it's a positive 3-day cycle. All right, and then lastly, if the open of cycle day 3 is below cycle day 1's low, remember that cycle day 1's low is the secure low. If it opens below that, all right, then that means we don't have a positive 3-day cycle. But we do typically have high odds on that day, cycle day 3, to come back above the cycle day 1 low, which then it would produce a positive 3-day cycle. It can be a little confusing. All right, that's why I want to, step with it. And again, you're going to definitely need to review this, all right, multiple times. All right, guys, I've been using the 3-day cycle for over 20 years. I learned about it many, many, many moons ago, and it's become a mainstay in how I do business, how I trade, what I look for. It forms a template. Okay. Again, nothing is perfect out there, but the beauty of it is it's flexible, and it keeps you in alignment. And you hear me talk about this all the time. Is that one of my core missions is to keep all our members in alignment with the larger institutional community. That's my background. That's where I want to keep you focused with. All right. If you're going to be trading in the same waters as the large sharks and the killer whales, well, we better be on the correct side of, along with them, right? I don't want to be bait. I don't want to be their food source. I want to be going along with them. So the 3-day cycle pattern has been around for years, 1940s, 1950s. A lot of people are not familiar with the 3-day cycle, simply because they perhaps never came across it. They were never taught it. All right. A lot of professional money managers, hedge funds, know about the 3-day cycle, and they've been utilizing it for years. Look, it may not be something that they want to, readily present to the public because it's been working so well for them. They're considered the smart money. Right? They manage trillions of dollars worldwide. So if you have, this group that understands how this cycle works, all right. Some people, we call it the 3-day cycle here. That's what George Taylor referenced it as. Some people use like a 2.5-day to 4-day cycle. Well, that's essentially a 3-day cycle, depending on how you want to adjust. Others out there use a 5 or a 7-day cycle. All right, whichever they want to use, that's fine. This particular one has stood the test of time over and over again. It's once you get the concepts down, it's fairly easy to understand. All right, but the beauty of it, we're reading the collective action of all these smart money guys buying and selling. All right, we have an understanding of how they act. All right, how they're expected to act. Okay, so if we have an idea of how they're expected to act collectively, we can make an observation using our OODA loop technique, right? Our OODA loop technique that we have in a prior workshop: observation, orientation, decision, action. So if we can use that technique to observe and have an understanding of what we're expecting to see, well, we can then make a judgment of whether or not that's actually happening or not. All right? So that's important, all right, in understanding and being mindful of the price action, at these key reference price levels, highs and lows. Okay? These violations and these penetrations. Okay? Friday is a holiday this week, and CD3 so will be Monday, and CD1, even though Friday is no trade. Correct. So today is CD1, which is Wednesday. Thursday, cycle day 2. Monday will be cycle day 3. Yes. All right. All right. So now, all right, in kind of a final conclusion here, all right, so we as individual investors, slash traders, all right, day trading out there, all right, trying to make a living, all right, we have a very important armament here. All right, and the armament simply is the knowledge now that we can evaluate what the smart money status is doing. right? We can trade and be on, trading alongside them as opposed to being, in front of them, right? I'd rather be, I don't want to be the last to know, right? And again, we talk about two groups that I identify: informed traders or uninformed traders. So do you want to be of the informed group or the uninformed group? Okay? Again, this is something that I've used for many, many years, and it's kept me whole. Longevity is really important in this business. And we spoke about, survivability and learning survival skills, all right, in trading, all right, especially the futures markets. You need to have the proper equipment, all right, to work with. And that equipment is knowledge, all right? And again, so now as far as I'm concerned, everybody, this rounds out the core of what Polaris Trading Group's methodology is all about. In prior videos and workshops, we've gone through various components, but this truly rounds out what I'm all about and what we look for, okay? So, I consider all our members here at Polaris as part of the informed elite group of traders or investors, not the uninformed, but we are part of the informed group. All right, so that's important. Yeah, CD3 this cycle will be Monday. So today is cycle day 1, Wednesday, cycle day 2, Thursday, Friday's off. All right, and I believe I'll know for sure, because I'm not sure if it's a short session in futures or not on Friday, but I know the cash session, of course, is closed, so that's going to push cycle day 3. All right, there is no futures. Okay, so then that will push cycle day 3 to Monday. All right. Well, it doesn't. The holiday doesn't skip a cycle. It pushes it. It's not a calendar cycle, if you think about that, Steve. So I think what you're asking is it a calendar day cycle? It's not a calendar day cycle. It's a trading day cycle. All right. Is it possible to post cycle day highs and lows at the end of every trading day? All it is, Ben, is the day's high and the low. Okay, well, I'm going to show you a. Let me just finish up here, all right, and let me just show you a couple things. Okay, so let me bring in a chart here. Okay, so what you're seeing on the screen here is the 3-day cycle on a 60-minute chart. So for brevity and so forth, this is the chart that I use, that I create every day for the daily trade strategy, and I've taken all the extraneous information out of it, and I've just focused on the cycle day levels. Now, what I simply do here is I post. By the way, this is done manually, this particular chart. All right, and I think it's important sometimes to do things manually, because the more you do things manually, you can get a sense of what's going on. If you have the computer calculate every level and high and low and so forth, and you just stare at it, you're not really being engaged with it. So it's important that you engage yourself with your charts. So this brings us to today. All right, so this is today's action on cycle day 1. All right, but let's just walk through this cycle, which was most recent. So instead of talking theory, all right, we'll actually talk the practicality of what happened over the past several days. All right, so on the past several days, let's just start with the cycle day 3 high over here. Now, this was the conclusion of a prior high, right? So again, this was cycle day 2's high, right? And on cycle day 3, this column here, right, they pushed it down. There was a rejection here initially, right, and then they rallied it up strong, and they closed the cycle day 3 high, and I believe this met projections for that particular cycle. So once these projections were met, the cycle day 3 targets, or the cycle high targets, going into begins a new cycle now. So from cycle day 3, the expectation is a pullback into cycle day 1 to find a new secure low. Now, momentum has a lot to do with how deep a pullback goes. So if you can visualize here, it should be fairly simple. On this cycle day 3, there was a lot of momentum to the upside. All right, that momentum does not reverse that easily. So on cycle day 3 down to the cycle day 1 low, okay, it was a shallow retracement. All right, I don't even think it met the average decline observed on cycle day 1. So it created a higher low, took out the prior high here, and that became the new secure low. All right, and then on cycle day 1 it started to rally. All right, so you got the rally on cycle day 1. So remember, though, if you take a look at today's cycle day 1 here to the right, well, this is a normal, actually, cycle day 1, right? We had expected a decline, we got a full decline. The cycle day 1 over here, we expect a decline, but it was shorter than the average decline that would be experienced on cycle day 1. What does that mean? It means that this is a powerful cycle here, and we should be expecting even higher prices to continue. So what happens? A low shallow is put in place, right? A shallow low early. Prices rally that day on cycle day 1. Can it rally on cycle day 1? Sure can. All right. Now into cycle day 2, what happens? All right. A backing and filling somewhat, a little bit of a pullback, very similar pullback to the prior day. Makes a higher low. So on cycle day 2, there's a lot of backing and filling, all right, that in a sense takes place, all right. Sometimes it tests the prior low, sometimes it creates a higher low, right? We don't know exactly, but we have an understanding of what may develop, and that's why we're actively, assessing what's happening throughout the day, all right. Remember, this is not a cookie cutter. This is a template of how the cycle typically unfolds, right? But there will be variance at all times of what the cycle norm will do. So that you got to remain, flexible in this. But understand these cycles. And again, like I said, the more you work with them, the more they will become understandable. All right. So what happens on cycle day 2, and what do we expect on cycle day 2? We expect that prices should close at or near the high part of the session. That's the expectation, that's the norm. What happens on cycle day 2 here? After early correction, prices close at or near the high point of the cycle. All right, on cycle day 2. Now, I'm not sure whether or not this met projections or not, but it did exactly what it was expected to do. Early in cycle day 3 session, failure to move above the cycle day 2 high. What does that create? That creates a failure, right, to push above the cycle day 2 high, right? So right in here, this creates a failure. What's the expectation if it can't get through the cycle day 2 high? Right? A pullback, a sell down. Right? Now, every cycle day 3 or 2 can have their variance. All right? So what happened here? They pushed it down early. There was some news overnight. I believe this happened to do with some of the Brussels bombings, if I believe. All right? So that disrupted the norm. The norm here would have been on cycle day 3, open higher above the cycle day 2 high. That would be the norm. But as I mentioned, geopolitical events, external terrorist events, all right, such as what happened. Guess what? It disrupted the norm. But what happened? Just like a kayak, I gave you guys the example earlier of the kayak, right? If you turn the kayak upside down and you're in it, right, what do? You can roll back up very easily upright. So this is what happened, all right, here on cycle day 3. They pushed it down, right? Well, the kayak rolled right back up, and cycle day 3 did exactly what it was truly expected to do. Clear the cycle day 2 highs, reach cycle targets, sell out longs from earlier price levels, and perhaps begin to establish short positions for the next cycle. We saw yesterday on this particular cycle day 3, they had trouble getting through the 2047s, and we closed with a $2 billion equity market on close sell imbalance. In the overnight, what did they do here? They tried to do what? They tried to get back above the prior cycle's high. Look at today's cycle's high here, right? About equivalent to cycle day 2, and failure to get above yesterday's cycle day 3 high. Guess what? That sets up a decline. Coming into cycle day 1, what's the normal cycle action? A move from cycle day 3 high down to cycle day 1 low. That would be the norm. Did the norm unfold today? Certainly did. Okay, so that's the cycle in action, and this was actually a very good cycle example here. All right, so now we closed in the low part of the range today, cycle day 1. We hit the actual low of day range projection that we had laid out in our daily trade strategy, by the way, to the tick. All right, that was nice to see. Tomorrow, cycle day 2. Well, prices closed low in its range. So what becomes the new cycle day 1? Now you can see here cycle day 1 low, Globex at 2027. That was the prior cycle over here to the left. So the 2025 25s becomes the new cycle day 1 key reference price. What happens tomorrow? Well, we're going to need to find out what happens in the overnight Globex. Do they continue to sell down? Do they hold the lows here today? What's going to happen during the cash session tomorrow? We'll evaluate when tomorrow comes. So what we do know, though, is once they do find a secure low, now whether today's low is secure or not, we'll know better tomorrow. But the expectation is once there is a secure low, cleaning out all the sellers, the expectation would be for a rally to begin on cycle day 2. And then there will be projections on how far that rally can take it based upon what the secure cycle low is. Today's low may or may not be the secure low. They may push it a little bit lower, find a lower point from which to have the cycle, all right, low point. All right, and again, whether or not it's a positive 3-day cycle on this next one going into the weekend and Monday will be how tomorrow closes and then how it opens on Monday, whether it's above or below cycle day 1's low. Cycle day 1's low is always a reference of whether the cycle is a positive cycle or a negative cycle. All right, and again, the probabilities favor 84% having a positive 3-day cycle. So that's pretty good odds. All right, so I'm going to make one final slide here. I want to preview going into part 2 of the 3-day cycle. So give me a moment to change the slide. Okay, so on this particular slide, what I want to do is preview you on part 2. And this is what we're going to discuss is the PTG TTT, which stands for Taylor Trading Technique ebook. Now, again, as I mentioned at the beginning of the presentation, the Taylor Trading Technique was invented by George Taylor. right? And it was a short-term trading technique, right? And again, essentially, we discussed about the 3-day cycle and being manipulated and driven by the smart money. Now, what he did is he used what he referred to as a book method. So he technically back then, back in the 40s and 50s, he had a little, notebook of sorts when he was in the pits, and he basically logged, what the highs of the days, the lows of the days, what key reference points were, et cetera, et cetera. And again, he always he measured out when the markets exceeded those highs. He made a note, how far did it exceed on cycle day 1? How far did it exceed on cycle day 2, if it did? All right, how many occurrences happened, etc. And he was very, it was very laborious, but he was very detailed about his work, and he did it in what's called, what he would refer to as the book method. All right, and so again, understanding his core premise that the market's manipulated in stages over repeated days, over and over, so this 3-day cycle repetitive process, all right, he was able to identify that on certain days, prices were able to move an average range above the prior high or low. All right, again, think about, logging these things day in and day out. All right, there's a lot of work doing it by hand. All right, so that was in the 1950s, and again, he kind of eyeballed things, and it was pretty, it was pretty accurate, and he actually became a very successful trader, understanding that these cycles and the ranges that they produced. So he was able to identify when the probabilities favored, as I said, key reversal points at these extremes where the markets are more likely ready to reverse. And then he was able to position himself, all right, alongside those so-called smart money, bigger institutional type players. All right, so that was what he did. Pretty insightful of the day. All right, now what we've done is I've teamed up with a gentleman by the name of Richard Boisvet, and he's a professional trader and money manager. I've been working with Richard for many years. All right, we have a great relationship. He's produced an electronic version of Taylor's book. So we're just calling it the ebook, and it's a proprietary spreadsheet. All right, he will not divulge the calculations from how it's created, but he has been able to work out an arrangement with me since we've been dealing with each other for many years, and I've been using his particular ebook. All right, up until recently, I've not been able to distribute it. I have not been able to show it, all right, without his permission. So I've been working with him over several months now to work out an arrangement where I can present it to our members and to the public. All right, and so what we've created is the ebook that I use on a daily basis to produce the daily trade strategy, and so forth and so on. So so the idea here is to, everybody wants to know, okay, so how do you know what the levels are? Right? Well, again, this spreadsheet does all the heavy lifting, all the calculation, all the mathematics that George Taylor did by hand, but now we're able to do it electronically. All right, and so now we get potential levels of support, resistance, the extremes. All right, and again, this shows what the smart money today is doing, and when we blend this into everything else that we teach and we work with on a day-to-day basis, okay, it forms again an outline of and a template of everything that we do. And again, as I said, this rounds out this methodology of mine, okay, that I've been really doing for, perfecting for well over 20 years now, all right, having worked for the investment banks. All right, yes, the individual ebook will be available for individual stocks and so forth. Here is a snapshot from Monday's session. And so, again, part 2, we're going to go into what the spreadsheet looks like, and again, I won't be able to go through calculations of how it's generated, but I will discuss the nature of the spreadsheet. Okay, and as you can see here, this particular spreadsheet, I get it on a daily basis. It is emailed to me. I believe I already received the one for tomorrow. But we got the S&P 500, E-mini here. We got Russell, and we got NASDAQ showing. I think there's a YM on this particular slide on the spreadsheet as well. I was not able to get it into view here. But it says, possible high for cycle day 2, possible low. It gives also handicaps, projections. So, for instance, on Monday, there's a 45% chance of making a high above, X price, all right, up to a high price. So there's a range of an average expansion to a maximum expansion, all right, from a maximum violation to a minimum violation. Okay, so there's a handicapping feature on a day-to-day basis. All right, and there's an average range that occurs. Again, we'll discuss all this in part 2. It's going to take a lot more time to go into this. All right, on cycle day, on the cycle days. All right, so I wanted to give you a preview, and let me just show you one last thing in terms of where you can get access to this now. All right, so on the website, we have a new section under the trading tab. If you were to go to the website, and it's called the PTG 3-day cycle. All right, so much of what you've learned already here today through this workshop, you'll see some references of this in this particular page. All right, and again, feel free to explore it. All right, now we have a complimentary document on the 3-day cycle. It's pretty much an outline of what we discussed here today. But now we have a subscription. All right, and right now we offer, or Rich and I together offer 8 different ebooks based upon the 3-day cycle Taylor method, and they cover certainly the U.S. index futures, European futures, U.S. stocks, right, Paul, gold, silver, and energy products, of course, oil, natural gas, etc., various soft commodities, Forex futures, and bonds and interest rate indexes. So, and it's simply, if you were to go to the subscriptions tab over here, all right, down below, you'll see a list of the 3 days cycle. Now, we have each particular product that I've just mentioned is listed in here. All right. So if you're interested in the U.S. futures or indexes or stocks, etc., okay, each of these particular products, guys, is $49.95. It is not part of the PTG membership. All right. We've gotten the lowest price possible that we can offer anybody. There is no discounts to this. All right, this is a very, very strict price, but it is available to the public, to all our members. I have not been able to, this was the agreement that I was able to forge with them and with Rich, and this is worth its weight. Okay, you see what happens on a day-to-day basis. So if you want that particular spreadsheet, on your desktop in the evening, ready for tomorrow, etc., for individual stocks or oil or gold or silver. I know some of you trade gold and silver, etc. It's the exact same concept that we use on the index equities, and again, they're read the same way, so you can use these for other instruments. But this is now available. It is on the website. All right. So if you are interested, feel free to go ahead and subscribe to it. All right. How many stocks in individual stocks? I don't have that answer. How many? If you ask me, I can find out for you. I'm not 100% sure. All right. I don't use it for individual stocks, but I'm sure there's a pretty good list. I would imagine that if you have a specific list for individual stocks that you're interested in. I'm sure the spreadsheet will be customized to what you want. But I'm not 100% sure. I can't imagine 5,000 individual stocks are comprised of the sheet on an individual stock basis. But I'm not 100% sure. So we can certainly find that out for you guys. All right. So if you do have questions about this, drop me an email. Let me know specific questions like Paul has presented here about the individual stocks. If you are interested, go ahead. You feel free to subscribe however you want. Part 2 of this, which we'll be discussing in more detail about the spreadsheet, will be our next workshop, hopefully scheduled for next week, but we'll see if we can get that on board. Otherwise, that's it for today. Hope you've found this insightful. Okay, and we can end the presentation here right now. So thanks very much for attending this workshop, and it will be recorded and uploaded to the website in a matter of a day or two. Thanks very much, everybody, for attending.